An interesting thematic ETF that has dropped significantly with acceptable valuations and potential for long-term growth, but also a lot of uncertainty, is the Chinese Internet ETF with the ticker QEB, which is the KraneShares China Internet ETF. By the way, this is a somewhat more expensive ETF with an expense ratio of 0.75%, and that has now been slightly lowered, maybe 0.7%, depending on the other broker. There's not a lot of relevant information to be found on the website itself, but of course they do provide the necessary information that they need to. Now, in the short term, leading up to 2025, this ETF seems to be gaining some stronger momentum. Don't forget, even if you think you're investing in a fund, the losses can be disastrous. Namely, it dropped by at least 80% from the all-time high in 2021 to 2022. And even today, the fund is still down 67%. When should you buy? When there's fear and panic. And when should you sell? When there's a hype. So it's better to buy low and sell high. But in practice, it's really difficult. By the way, it's still possible that the fund could drop even further. And it could also be the case that, as you can see in the long term, there might be almost no price development, like here between 2014 and 2016. But actually, if you had bought in 2014 and now you're in 2024 or early 2025, you could still be at a loss. So it's not always easy to say that every thematic ETF is profitable. There are times when it can be very profitable, and there are times when it can actually be unprofitable, even in the long term. So be careful with what you do. Personally, I find the KraneShares China Internet ETF quite interesting, and the reason is that it contains some really strong companies. If we take a look at the holdings, you'll see a sector breakdown across different sectors and the top 10 holdings, which you can also find on the website. You go to the KraneShares website and you find the ticker QEP, then you go to holdings and here you find the top 10. And if you download the full holdings, you'll find an overview like this one, where you can also see other smaller holdings. Some names mean nothing to me. Maybe more importantly, the top 10 includes well-known names like Tencent, which has a really strong moat. But you can say the same about others, like Alibaba, of course, and for example, JD.com is definitely a very interesting stock. You could even consider buying JD.com as an individual stock, but that's for advanced investors. Trip.com has been doing really well lately, but more importantly, the total holdings are just 33 Chinese internet companies, also all from China. So you have geographical risk from a country that is quite uncertain, especially now that the United States, with Trump, might make some crazy moves. And another thing is that the top 10 holdings make up 62% of the total fund, so that's not really very good. Moreover, in terms of rating at the moment, the KraneShares Internet ETF is getting a strong sell based on a database that compares this ETF with more than 2,000 other ETFs, and momentum is a very important factor. You also see that the costs get a D+. That's not good, because this fund has higher costs. It's more expensive. No dividend or almost no dividend. It's also risky because it's very volatile. That's why it gets an... Only liquidity is actually positive at the moment and will likely remain positive in the future. But momentum is a very important factor. In this data model, and yes, you see the 5-year return of the ETF is minus 26%, so that's just super bad. You can also see that the median of all ETFs has had a positive return over the past 5 years, while the Chinese Internet ETF has dropped 26%, and also in the short term, it's not doing very well. But during the dip, it can sometimes come in handy. Of course, even though China has announced a huge government stimulus, it's still a market that's hard to read. So it remains risky. The result can also be significantly disappointing in the long term. A lot of core selection can be interesting for long-term investors, but what you really want to do is anyway. Buy when the fund is very low and sell when the fund is at a significantly higher level. So pay close attention. This is not just a passive long-term investment, because you see the results can also be significantly disappointing in the long term. Buy when the fund is very low and sell when it finds itself at a significantly higher level. Nevertheless, it's interesting, maybe for the more advanced investors